So, business income tax is just a tax on the profits earned by the business. So, you have your taxable income. So, taxable income is the amount of income that is subject to tax. So, for businesses, taxable income is calculated by subtracting allowable deductions from the gross income. Deductions can include expenses such as rent, salaries, and supplies. The resulting amount is the taxable income. This is why it's so important to maximize your deductions. Because let's say I made $100,000 this year and I was able to deduct $50,000. That means I'm only being taxed on the other amount, the $50,000 that's left. And I'll use some better numbers here. Let's say I made $10,000 last year and I was able to deduct $7,000. That means I'm only going to be taxed on the $3,000 that's left. So now tax rates. The tax rates for businesses depend on business structure and the amount of taxable income. Sole proprietorships, partnerships, and LLCs are taxed at the individual tax rate of the owners, which if you are an independent contractor, which we'll talk about later, you're taxed at the self-employment rate, which is 15.3%, and there are some ways to get around that. But corporations are taxed at a flat rate of 21% on their taxable income. It's important to note, though, that tax rates change over time due to changes in tax laws. But as you can see, corporations are taxed at a much higher rate, which is why they do everything they can to deduct as much as they can. They have nonprofits and whatever else they're doing. That's why Warren Buffett pays, less than 1% or whatever it is on his taxes for Berkshire Hathaway. So let's talk about tax credits now. So tax credits are a way for businesses to reduce their tax liability. Tax credits are applied directly against the amount of taxes that are owed. So going back to my previous example, if I was able to deduct $7,000 from the $10,000 I made, that means I have to pay taxes on $3,000. But if I get a tax credit, let's say on that $3,000, I have to pay, $1,500 in taxes. A tax credit will take that $1,500 and reduce it. Some examples of tax credits include research and development tax credits and the small business healthcare tax credit. Moving on to tax filing. So businesses must file an annual tax return with the IRS to report their taxable income and calculate their tax liability. The tax return must be filed by the appropriate tax deadline for business structure, which can vary obviously depending on the type. In addition, businesses must pay the estimated taxes throughout the year to avoid penalties and interest charges. Some big businesses will make tax payments quarterly. This way, by the end of their tax year, that March 15th, April 15th deadline, it's a little bit less of a burden unless they know they have enough deductions and credits to reduce that liability and how much they need to pay. And then again, tax planning. Tax planning is the process of making strategic decisions to minimize a business's tax liability. This can include optimizing deductions, utilizing tax credits, and structuring the business in a tax-efficient manner. It's important for the business to work with a tax professional again, but I highly recommend that as you're tracking your expenses, you start to categorize these things. Now, later on in this course, I'm going to give you a bunch of IRS publications and some things that you can deduct. Start to categorize your expenses based on those, whatever's in the IRS publications, like office expenses, gas, food, whatever the case is, travel, all of these things. Make sure you're categorizing them when you're tracking your expenses. This way, at the end of the year, when you or your tax professional go to file your taxes, you know exactly how much you can deduct. So I'm going to list off the, filing requirements for each one of the different types of business structures. I'm also going to include S corporations, so you have a general idea of what that looks like. So for sole proprietorships, again, file an annual tax return, the 1040, with a Schedule C reporting the business income and expenses. You're going to pay self-employment taxes, which is going to include Social Security and Medicare taxes on the net income. If annual business income exceeds more than $400, you're going to file quarterly estimated taxes using the Form 1040-ES. Partnerships. You're going to file an annual tax return Form 1065 with the Schedule K1 reporting each partner's share of the business income and expenses. you're going to pay self-employment taxes on each partner's share of the net income. If annual business income exceeds $1,000, you're going to file quarterly estimated taxes using the Form 1065-B. LLC. Single member LLCs are going to file an annual tax return 1040 with the Schedule C reporting business income and expenses. Multi-member LLCs are going to file an annual tax return Form 1065 with the Schedule K1 reporting each member's share of the business income and expenses. LLCs are going to pay self-employment taxes on each member's share of the net income. If the annual business income exceeds $400 for the single member or $1,000 for the multi-member LLC, you have to file quarterly estimated taxes using Form 1040-ES for single member or 1065-B for the multi-member. Corporations. Corporations file an annual tax return Form 1120 reporting corporate income and expenses. They're going to pay corporate income tax at a flat rate of 21% on net income. If the annual taxable income exceeds $500,000, so $500,000, they're going to file quarterly estimated taxes using a Form 1120-W. And now S Corps. So S corporations file an annual tax return Form 1120-S with the Schedule K1 reporting each shareholder's share of the business income and expenses. S Corps are going to pay self-employment taxes on each shareholder's share of the net income. And if the annual business income exceeds $1,000, an S Corp must file quarterly estimated taxes using the Form 1120-W. Now, it's also important to note that these requirements may vary depending on the state. There could be state laws, local tax laws. Again, look it up for your state specifically. These are the federal requirements. All right, everyone's favorite, deductible business expenses. So deductible business expenses are the costs associated with running your business that can be deducted from your taxable income. This is going to include expenses such as your office rent, utilities, supplies, and employee salaries. These expenses are subtracted from your gross income, resulting in a lower taxable income and, in turn, lower taxes. So why is this so important? Understanding and taking advantage of deductible business expenses can significantly lower your taxable income and save you money. By deducting expenses that are necessary to run your business, you can keep more of your hard-earned money and reinvest it into your business. So, how do you determine what is a deductible business expense? You first have to determine if they are ordinary and necessary. Ordinary expenses are common and accepted in your industry, while necessary expenses are helpful and appropriate for your business. For example, if you own a photography business, the cost of camera equipment and supplies is considered an ordinary and necessary expense. Once you've determined if an expense is ordinary and necessary, you can deduct it from your taxable income. Again, keep accurate records of all expenses, including receipts, invoices, and bank statements. This is going to make it easier for you to determine which expenses qualify and calculate the total deduction. Now, let's go through some of the deductions that I have here on the screen. We have office expenses. So this is going to include your rent, mortgage payments, utilities, maintenance and repairs, office supplies, and equipment such as computers and printers. So if you have a home office and you're paying rent or you're paying, mortgage, now let's say I have a 1,000 square foot house and my home office is 100 square feet, that's, 10% of my house. I'm able to deduct 10% of my mortgage payments, 10% of my rent, 10% of my utilities, so on and so forth. Business travel expenses. So this is going to include transportation, lodging, meals, incidental expenses incurred while traveling for business purposes. Business insurance. This includes liability insurance, property insurance, and business interruption insurance. Employee salaries and benefits. This is going to include wages, salaries, bonuses, such as, benefits like healthcare, retirement plans, and paid time off. Then you have professional services. This includes fees paid to lawyers, accountants, consultants, and other tax professionals for services related to the operation of your business. Next is my personal favorite, which is advertising and marketing. This includes expenses related to advertising, marketing, and promotions of the business, such as web design, social media advertising, and print ads. There are tons of ways to deduct advertising and marketing from your business expenses because, there's no clear-cut answer as to what's advertising and marketing. So anything you do to promote your business, you can categorize as advertising and marketing and then write it off or, deduct it. Next is depreciation and amortization. This includes the gradual loss of value of business assets over time, such as buildings, equipment, and vehicles. The most noteworthy is electronics. So if I bought my laptop for $2,000 and it's going to last me 5 years, that means that I have, it depreciates $400 every year because the life expectancy is 5 years. I spent $2,000 on it. That means that every year I can write off or deduct $400 because I'm using this laptop for my business. Another thing I want to mention is anything that you do to improve yourself as a business owner and to help support your business is also a tax write-off, meaning this course is a tax write-off. Any material that you buy is a tax write-off. So if you purchase the textbook, that's also a tax write-off. So save your receipts for these things. Now, I did want to make one other note that not all expenses are deductible. Expenses that are considered personal or unrelated to the operation of the business are not deductible. Now, some expenses may be partially deductible. This is going to be things like your meals. Again, I'm going to leave a bunch of IRS publications in the textbook for you to look up. This is going to be publication 535, 334, 463, and 583.